Did you know that investing as little as $1,000 in MSTY could pay you about $40 every single month? That kind of passive income grabs attention fast, especially when you realize MSTY's 12-month trailing yield has hovered between 3% and 5% per month, much higher than what you'd see from most traditional dividend ETFs. But here's the catch. Those payouts come with a double whammy risk. Not only can your monthly income fluctuate, but your original investment, or principal, can also shrink over time due to capital depreciation. In other words, high yields might actually eat away at your account balance if you're not careful. So how does MSTY make these big payouts possible, and what makes it stand out from other income strategies? Let's break down why this high-yield ETF is turning so many heads among investors seeking more from their money. MSTY stands out because it offers something rare in the world of income investing: extremely high yields with a surprisingly low capital requirement. Its trailing 12-month yield has ranged from 40% to 60% annually, translating to about 3% to 5% per month. To put that in perspective, a $1,000 investment could yield around $40 every month, while $10,000 could bring in $400 and $25,000 might generate $1,000 per month. These numbers are eye-catching for anyone looking to boost their cash flow without locking up a huge amount of money. Compare that to a traditional dividend ETF like Vanguard's VYM, which typically yields about 3% annually. To generate $1,000 per month from VYM, you'd need to invest over $400,000. SCHD, another popular dividend fund, has a similar yield, so it too would require hundreds of thousands of dollars to match MSTY's monthly income potential. This stark difference is a big part of MSTY's appeal, especially for investors who want meaningful monthly payouts but don't have vast sums to invest. What makes MSTY's approach so different? The fund doesn't depend on dividends from a basket of stocks. Instead, it uses a covered call strategy that targets a single underlying stock, MicroStrategy or MSTR. MSTY sells monthly call options on volatile MSTR to collect rich premiums, which fund its monthly distributions. The volatility of MSTR, fueled in part by its close ties to Bitcoin, means the options MSTY sells can command much higher premiums than you'd see on more stable, traditional stocks. This is what allows MSTY to deliver such high payouts even with a modest investment. But there's a trade-off. The income MSTY generates is not fixed. The amount you receive each month depends on how much the fund earns from selling options, which can change from month to month. Some months the payout could be 3%. Other months it might reach 5%. This variability is a key part of the fund's risk profile, so investors need to recognize that the income stream isn't guaranteed or consistent. Another factor is the strategy's reliance on a single, highly volatile stock. MSTR's price swings are often dramatic, driven by Bitcoin's performance and broader market sentiment. While this volatility can boost the premiums MSTY collects, it also introduces the risk of sharp declines in the value of the ETF's underlying holdings. If MSTR's price drops significantly, the fund's net asset value, NAV, will likely fall as well, even if the monthly payouts remain high for a time. It's also important to note that MSTY's covered call approach puts a cap on how much the fund can benefit if MSTR's price surges. When MSTY sells call options, it collects premiums, but gives up the right to participate fully in any big price jumps. So, if MSTR rallies sharply, MSTY's upside is limited compared to simply holding the stock outright. This ceiling on gains is an inherent part of the strategy and something every investor should factor in when considering the ETF. Despite these limitations, the math behind MSTY is compelling for a certain type of investor. The ability to generate hundreds or even thousands of dollars in monthly income from a relatively small investment is hard to ignore, especially when traditional income funds require much more capital to achieve similar results. For income-focused investors who are comfortable with the risks, MSTY offers a unique way to pursue high cash flow. But there's more than meets the eye. Let's unpack the hidden trade-offs next. Picture this. You invest $10,000 in MSTY and collect $400 every month for half a year. That's $2,400 in income. Pretty compelling at first glance. But then you check your account and see your original investment has dropped to just $7,000. That's the reality of MSTY's risk profile. While the income can be impressive, the underlying value of your investment can shrink at the same time. This is the heart of the income versus capital loss dilemma that comes with high-yield options-based ETFs like MSTY. The reason for this risk starts with MicroStrategy, the company MSTY is built around. MicroStrategy holds over 200,000 Bitcoin, making its stock a direct proxy for crypto volatility. When Bitcoin's price surges or tumbles, MSTR's stock moves right along with it. Because MSTY's income strategy depends on selling options on MSTR, your returns are tied directly to the wild swings of both the stock and, indirectly, Bitcoin. Bitcoin has swung 10 to 20% in just a few days before, so MSTR, and by extension MSTY, has seen similar moves. If you're invested in MSTY, you're not just betting on a tech stock. You're riding the highs and lows of the crypto market, sometimes without even realizing it. The covered call approach MSTY uses is designed to generate high income, but it comes with a trade-off. By selling call options on MSTR, the fund collects option premiums, which fund those monthly payouts. But this also means giving up the chance to fully benefit if MSTR's price surges. When the stock jumps, MSTY's gains are capped because it's already sold away the upside in exchange for regular income. It's like loaning out your winning lottery ticket for a quick paycheck. Over time, this strategy can feel rewarding in volatile markets, but it also means you'll never capture the full reward of a big rally. There's another layer to this risk: yield decay. While MSTY's distributions can seem like a winning formula in the short run, the ETF's share price can trend downward over time, especially during prolonged drops in MSTR's value. Every month, while you're receiving high payouts, the net asset value, NAV, of the fund, the part tied to the underlying stock, may be slipping lower. This is known as NAV erosion, high payouts but a sliding share price over time. The income cushions the blow, but if the share price keeps dropping, your total return can end up negative even after factoring in all those distributions. Let's go back to our earlier example. You invest $10,000 and pocket $2,400 in 6 months. But if MSTR falls by 30% during that period, your investment is now worth just $7,000. Even after collecting your payouts, you're still down $600 overall. The monthly income is real, but so is the risk that your principal shrinks faster than you can collect distributions. This isn't just a rare scenario. Bitcoin's history of double-digit swings means these kinds of price drops aren't unusual. When volatility spikes, MSTY's option premiums can rise, boosting payouts. But when volatility fades, or if MSTR's price tanks, the premiums drop, and so does your monthly income. Both your payouts and your principal can get squeezed, sometimes at the same time. MSTY's high-yield promise is best suited for investors who understand these trade-offs and are comfortable with risk. It isn't a conservative, slow-growth ETF. Instead, it's a speculative vehicle built to reward those who can stomach volatility and accept that both income and capital can fluctuate sharply. If you're considering MSTY, it's wise to treat it as a satellite holding, a smaller, riskier part of a diversified portfolio, rather than the foundation of your income strategy. Reinvesting some of your payouts or limiting your allocation to MSTY can help balance the potential for capital loss. Of course, there's another factor that can chip away at your returns, one that many investors overlook at first. Even if you're comfortable with the ups and downs of MSTY's share price, there's still the matter of taxes, which can quietly eat into your high-yield income. What if Uncle Sam takes a quarter of your 5% yield? Here's why MSTY's high payouts hit you with high taxes. The core issue is how those attractive monthly distributions are taxed. Unlike traditional dividend ETFs, which often pay qualified dividends taxed at lower rates, MSTY's payouts are mostly classified as short-term capital gains. These are taxed as ordinary income, which can make a major dent in your returns, especially if you're in a higher tax bracket. Let's break it down with a simple example. Say you're in the 24% tax bracket and MSTY pays you $2,400 in distributions over the course of a year. On paper, that looks like a solid boost to your income. But after taxes, you're left with $1,824. $576 goes straight to the IRS. If you're in the 32nd% bracket, your tax bill jumps to $768, leaving you with just $1,632 from that same $2,400 payout. The higher your income, the more taxes eat into your yield. Suddenly, those impressive monthly payouts don't seem quite as generous. This tax drag happens because of how MSTY generates its income. Most high dividend stocks pay qualified dividends benefiting from favorable tax rates, often 15 or 20% depending on your income. MSTY, on the other hand, earns distributions through a covered call strategy, selling options on MicroStrategy stock. The income from these options is considered short-term capital gains, so it's taxed at your regular income rate. That difference in tax treatment can make a big impact on your real after-tax yield, especially if you hold MSTY in a taxable account. High payouts feel great, but taxes can quickly drain them. The good news is you can take steps to minimize the impact. The most effective way is to hold MSTY in a tax-advantaged account. If you use a Roth IRA, you can enjoy all those distributions tax-free, as long as you follow the withdrawal rules. In a traditional IRA, you defer taxes until you take money out, letting your income compound without immediate tax drag. These accounts are particularly valuable for high-yield, tax-inefficient investments like MSTY because they let you keep more of what you earn. If you're investing through a taxable account, it's even more important to know your tax bracket and plan ahead. Set aside a portion of your monthly payouts so you're not caught off guard by your tax bill at year's end. For some investors, especially those in lower tax brackets or with minimal other income, MSTY's distributions may still be attractive after taxes. But for many, the tax bite is a key reason to consider tax-advantaged accounts as the first stop for high-yield strategies. Tax efficiency isn't just a detail. It's a crucial part of understanding your true return from MSTY. The difference between gross yield and what you actually keep can be the deciding factor in whether MSTY is a smart addition to your portfolio or a costly misstep. Before you get too excited about the headline yield, take a close look at your personal tax situation and consider consulting a tax professional or a financial advisor. A little planning can make a big difference in how much income you actually keep. With taxes understood, let's see how MSTY fits into your portfolio without derailing your goals. Think of MSTY like hot sauce. It brings heat and excitement to your portfolio, but too much can quickly overpower everything else. This ETF is designed for those who want extra kick in their income strategy, aggressive investors who understand and accept the risks that come with chasing higher yields. MSTY thrives on volatility and unpredictability, so it's not meant to be your core holding or a safe, slow-growth option. Instead, it belongs on the side, adding flavor in small, controlled amounts. MSTY is not a bond alternative, and it's not a substitute for the steady growth you get from index funds. Those investments are built for stability, aiming to preserve capital and deliver consistent returns over time. MSTY operates on the opposite end of the risk spectrum. It depends entirely on the wild price swings of MicroStrategy, a stock that mirrors the ups and downs of Bitcoin. For investors who prioritize principal protection or need reliable, predictable income, like retirees or anyone with a low risk tolerance, MSTY isn't a good match. It's more suited to those who are comfortable with speculation, understand the mechanics of options. What draws many to MSTY is its potential for high monthly yields. With distributions ranging from 3 to 5% per month, it's easy to see why yield chasers and Bitcoin bulls are interested. The fund strategy, selling call options on MSTR, allows it to generate substantial income when volatility is high. But here's the important trade-off. By selling those calls, MSTY gives up the chance to fully benefit when MSTR's price soars. If the underlying stock has a major rally, MSTY's gains are capped, so you collect solid income but miss out on the biggest upside moves. The fund profits from the chaos, not from steady growth or long-term appreciation. Because of this, MSTY is best used as a small, strategic slice of your overall portfolio. Many aggressive investors cap MSTY at 5% or less of their portfolio, keeping 95% in steadier assets like core index funds, bonds, or dividend stocks. This approach lets you benefit from MSTY's high yield potential without taking on unnecessary risk. If MSTY underperforms or the market turns against it, the damage to your overall wealth is contained. Diversification is your main defense here. MSTY can spice up your returns, but only if it stays in its proper place. Treating MSTY as a supplementary tool also means managing your expectations. The income it generates can be impressive, but it's not guaranteed or consistent. Market conditions, especially volatility in MSTR and Bitcoin, play a huge role in how much you'll actually receive each month. There will be periods when payouts are strong, and others when they're thinner. It isn't a set-it-and-forget-it ETF. You need to monitor your allocation, stay informed on the fund's performance, and be ready to adjust your position if the risks start to outweigh the rewards. If you're looking to boost your portfolio's yield and you're comfortable with volatility, MSTY can be a valuable addition, but only as a small part of a diversified strategy. Avoid the temptation to go all in based on headline yields. As the research and expert advice suggests, you just don't throw your entire portfolio into it expecting a guaranteed 60% return. That's how people get burned. The real key is knowing your risk tolerance and making sure MSTY fits your overall financial plan. Understanding MSTY's role means recognizing both its strengths and its limitations. It's not a source of stable, safe income, and it won't protect your capital in a downturn. What it can do is offer a unique, high-octane income stream for those willing to accept the risks and the possibility of NAV erosion over time. If you're strategic and disciplined, MSTY can help boost your passive income without derailing your long-term goals. Treat MSTY as a spicy side dish. Small dose, big flavor, never your main course. And if you're considering adding it to your portfolio, make sure you understand exactly what you're signing up for. As you weigh MSTY's appeal, remember that its standout monthly yields come with real trade-offs. The opportunity to earn 3 to 5% per month is balanced by 3 major risks. Your principal can decline sharply, payouts can swing from month to month, and taxes can take a significant bite out of your income. These factors make MSTY a tool for aggressive income seekers who are comfortable with volatility and uncertainty. If this helps you understand MSTY's trade-offs, hit like, subscribe, and let us know your experience with high-yield ETFs in the comments. Thanks for watching, and invest wisely.